All right, yo, what's going on, guys? This is just gonna be a quick video. I want to explain and clear up the confusion on order blocks and breaker blocks, and what they are, if you don't know. So let's get into it. So here we go. So here's the hourly chart. An order block is defined as the last move up before a move down, or the last move down before a move up, as far as candle closure goes. So this drastic move up right here, the last move down with candle closure would be this one right here. This one right here, right? Because it was the last down closed. It closed completely, right? Candle before the move up. Now, how you would mark that out, I like to use the rectangle tool, and I personally don't use the wicks. Some people do. I don't really think it fucking matters. I think at the end of the day, you just need it. You don't use it for precision and like, oh, I want a perfect tap into this. You look at it for, will price respect this, or near this, or in this, or maybe a little past this? Will price end up drawing past this? Because an order block is defined as a place of resting orders. Think about how the market would act right here. So the market comes up. Think about how people, would act right here. The market is skyrocketing. It took out this high right here, skyrocketing. A lot of people want to get a good entry. They didn't, maybe someone entered here or something. They want to get a good entry, so a lot of resting orders are going to be right here. So the market, that's liquidity. Market wants to take that, right? So at the end of the day, that is how you define an order block. That is a bullish order block. So how it would look like is if price came back into it, if you're bullish, it would tap into this. This is a red candle, meaning it's bullish instead of bearish, so it's like flipped. And this would be a bullish order or a bearish order block right here. This is the last up close candle before the move down. It's not as drastic of a move down, but it's definitely a good one. So, but the thing is, you can't just do that for every single one. Like this one, you can't do it for every single one like this. The same applies with fair value gaps and liquidity. I could sit here and mark out every high and low, but at the end of the day, price doesn't really care about these. It could, but it doesn't. Like, it's good. Maybe you might want to keep an eye on maybe this one because it's close to it, because price doesn't always sweep the actual buy side liquidity completely. Sometimes it goes like this because it taps into the order block and it tanks, right? That's why. Order blocks are why it does that, and that's why I love order blocks so much. But anyways, like I was saying, what you'd be looking for if you were bullish is maybe for it to come here, tap into it, fill more orders, and then go up and take out liquidity. Or it could turn into a breaker block. Now, a breaker block is whenever it comes down, trades into it maybe for a second, and then has a strong candle closure below it. Strong. Like, I don't mean like just right here or like barely wicking it. I mean it closes below it strongly. Then it turns into a breaker block. A breaker block is like an inverse fair value gap for order blocks. It turns into an inverse order block. So now this was bullish, now it's bearish, right? You don't just say, okay, I'm going to enter off this and place a limit, and I'm going to assume it's bullish. It, in theory, is bullish. But if it comes down, it's now bearish, and it needs to come back up. Tap into this, and that'd be a good place for it to come down. Does that make sense? So that's how you. That's basically how you explain order blocks. Same with this, right? We could come up, tap this, and tank, or we could come up, close above this, come back into it, and go up. Some people call it break and retest. But that's not what I call it. Not even close. Now, order blocks are where smart money enters. Smart money enters with thousands of contracts, way more than I trade, like significantly, and they enter in these high probability order blocks. You need to not just sit here and identify, and this goes for any conference I teach, and just sit here and identify every order block, every breaker block. It's not going to help you. It's just not going to help you. Like, you need to look at what price is likely to respect. So I would say at the high and low of a range, the last one over a big range like this, whenever we create a big range like this internally or externally, whatever it is, those order blocks at the top and the bottom of them are very high probability. Because, like I said, if you're wondering why sometimes price comes up and fails to take a high, here we go. Because it happens sometimes where price will come up and failed to take a high. This high right here, it failed to take it, right? Sometimes there are order blocks that are resting in there. There's a breaker block right here. So this tells me, right, that I'm not just going to have tunnel vision from one confluence. I'm going to look at everything, right? Because you use these like tools, whatever tool for the job works, right? Like I wouldn't use a pickaxe to dig in the dirt. I would use a shovel, right? So I wouldn't use a hoe to mine a fucking diamond in Minecraft. Like this shit right here is an order block. It's the last move down before move up, right? Down close candle. That's the order block. It came up once. It came up twice. It showed 2 signs of rejection. It happened to tank this second time, right? You could have made money both times. This one or this one. That's what you need to do. Order blocks help me tie it in with narrative. I don't necessarily always enter off order blocks, but they are great for narrative, like I said. So focus on that. Focus on these high probability liquidity order blocks, high probability liquidity ranges, things like this, right? This is what I'm looking for. So price doesn't necessarily have to come up and take this liquidity, but if it comes up and comes back down, you need to look back on it and static test and say, okay, cool. Why did price not take this high, but it went here? It's because of the order block. It's because of the order block, I'm telling you. Now, sometimes price will have a weak closure due to slippage. It'll have a weak closure above an order block. Let me find one. Well, this isn't a weak closure, but I can go over this. This order block right here. Price isn't going to be always the perfect, most precise thing due to turtle soups and manipulation, but price is going to come down, and right here, you can anticipate. You shouldn't enter off of this, but what you should be looking for is maybe price to respect this if you're bullish. If you're bearish, you want price to strongly disrespect this, come back up, maybe tap into it, and then pair it with a bunch of other confluences. But this right here, price generally respected this. That's what matters. It also took out this sell side right here. Oh, it didn't quite take it. Nope, they're relatively equal lows. That's my point. That's why I don't always put my take profit at sell side or buy side. You need to find resting liquidity. Fair value gaps are one. Order blocks are another. This is all where smart money enters, and smart money use these concepts right here. Now, obviously, just like any other confluence, you need to tie it in with context, right? Context matters so much. You can't just find the first order block, the first fair value gap, the first inversion, the first PD array of any kind that happens, and be like, okay, cool, I'm going to enter off that for no reason. Because you're not really learning anything, you're just gambling. You need to find what the market looks like it's likely to do. This tied in with context, I could see, okay, cool, it rejected here. I want to see if it rejects here. This would be, in my opinion, considered a strong candle closure. Not once, but twice below. That's even better. Even more confluence. Comes back up. Now look, we close below it. It is a breaker block, right? Now, because we close below it, like I said, look at this. We come up, we close, and then we immediately start tanking back down again. Come back up, manipulate. Bunch of manipulation happening. Long wicks here, but it inevitably respected it. I'm not going to say that's the only reason that happened, because we also had a turtle soup right here, but you pair it with confluences before a big move happens. That's my point. We had a huge turtle soup here. We had already signs of respect for this order block. Weak closures above. I don't expect this one to close above. It didn't. Entry would probably somewhere right here to trade to this external right here. It's that simple. So there are 2 types of order blocks. There's unmitigated and mitigated. So mitigated means they've been tapped before. So something like this is a mitigated order block. I don't want to say these are low probability. I want to say they're more medium probability. But if they turn into a breaker block, they're high probability. Again, they like reset. That's the way I like to look at it. Unmitigated means they haven't even been touched. These are great to look at, like something like this. The order block was created. It hasn't been touched. The longer it goes without being touched, the more desirable it is. The best way to think of it is think about how desirable price is. This high right here, right? It's pretty desirable. Bulls probably want to take this out this low. Bears probably want to take out. But think about this high, right? I would consider this high, not just because it's higher and it's worth more, but this high has more intrinsic value, because if we take this out, people make even more money, especially options traders or people who are swinging. People make even more money, right? And that's where a lot of institutional traders go. They do off short, long-term plays. It's like a couple days. It's not just like in and out, 30 seconds, right? Like this high right here is going to be much more sought after. People really want this high than maybe just this high right here. I'm not saying that this high can't. My point is this high can turn into that high, but you need to look at liquidity as what's desirable and what do people want. People want to take out this high. People want to take out this order block, right? So there's resting orders there. Probably limits already there to go short for whenever anticipating reversal because they're anticipating it. Or maybe their take profits are there. That's a resting order to close a contract. Same fucking shit. Maybe their stops right here. That's my point. Yeah, and like finally an example, the last example that I'll use is low prob, like shit like this. I'm not saying low probability doesn't mean that it's not going to happen. It just means if price comes up and taps this and it rejects, that doesn't necessarily mean I'm not as likely to believe it's going to hold below. It could come way down and then it could just skyrocket right through it immediately after. But something like this, I might even see it skyrocket initially, maybe up to like here or these levels right here. You might see it skyrocket initially, but then it's going to have a long wick whenever you find out that candle closes, right? That's what matters. So it's all about context. So if you have any questions about it, just leave a comment down below and just please like, subscribe, favorite. I'll see you guys next time.